Hello and welcome to Livewire Markets. My name is Anna Dadich. Today I'm speaking with Alex Hone, Managing Partner of Keyview Financial Group. In the wake of the ASIC review of the private credit market, we're going to discuss the changes ahead in 2026 and where Keyview are seeing opportunity in the sector. Welcome, Alex. It's great to have you.
Thanks, Anna. Good to be here.
Can you start with an overview of what the private credit landscape looked like leading up to the ASIC review?
Sure. So people don't know, ASIC came out with a review last November, which was basically a summary of discussion points or findings they'd been looking at for some time. The industry is relatively new. I mean, at the end of the day, private credit's been a staple of Australian financial markets for some time, but as a accepted modern asset class, it's probably been growing over the last 10 years or so. So, yeah, in the context of broader markets, it's relatively new. But within that, there's probably, really a small handful of what I'd call larger independent groups, so non-bank groups. There's probably a handful like ourselves of what I'd call mid-sized groups, and there's a plethora of small groups. Again, barriers to entry are low, and so the dynamic is one where there's not a huge number of what I'd call larger players, but it's a reflection of its relative newness.
Why was the review necessary and what were the areas of concern that were called out?
I think one of the interesting things is where most participants came in the marketplace and how they came into participating. A lot of groups have been born out of commercial banking backgrounds or investment banking backgrounds, very distinct from groups like ourselves who've come from a more purist funds management background. And so for them, it's not as normal, or they've probably more brought some of those commercial traits that might exist within commercial banks and investment banks and thought to apply them into a funds management environment, which the ASIC reviews really highlighted aren't appropriate.
Yeah. Okay, so from your perspective, which of those risks were most valid?
Well, firstly, what were the issues that ASIC identified? It related to governance, it related to fee disclosures, it related to broader portfolio disclosures, misalignment with investors, transparency, just what you'd think of all the foundational Funds Management 101 topics were. And so, in essence, all of them are essential. ASIC has provided a very clear set of guidelines up front about what best practice looks like. If you've been in the industry for a long time, none of those things read as revolutionary. I mean, avoiding misalignment with investors should be, the staple of every funds management house out there. People shouldn't need to be told that not disclosing their fees, not provide full transparency to clients about what risks are in the portfolio. I mean, they're all very foundational and obvious things for an industry to get their head around. And so all of them are very, very valid and applicable for the industry to take heed of.
Okay, so where to from here? Do you think ASIC is likely to issue new regulations in 2026?
It's going to be interesting to see. I mean, ASIC's always got a lot on their plate and they shouldn't have to have written the report in the first place, really. But I think a lot of it's going to come down to how the industry responds. There are wholesale changes we know some of the larger fund managers have to make to their products where they were earning fees at the underlying loan levels and not disclosing those fully and transparently at the product at the fund level. So those changes will no doubt come through this year. But if the industry is slow to adopt, or similarly the pressure applied by investors is not as strong as it should be, then I'm certain that ASIC will be more forthright. They've also been clear that they're going to take some of these things very, very seriously. So where boards have been signing off on offer documents which are misleading, I mean, that's within the staple of ASIC's surveillance and governance frameworks to sort of enforce those things as well. So whether they come through with new regulations this year or not, I'm less sure, but certainly their response will be a function of how well and quickly the broader market, who have been structured inappropriately, respond to their outlines.
Okay, so in your view, what does best practice look like in private credit? And specifically, how has Keyview positioned itself to meet those expectations or exceed them?
Well, we were really pleased with the report. So for us, it was a validation of how the business had been set up from day one. And again, like I said earlier, Anna, there's nothing in that report which is revolutionary. I mean, to have offer documents which are clear about the sort of things you're investing in, to have ongoing reporting, which is providing transparency for investors sufficiently to understand what's in the portfolio, to ensure that you're not actually charging any fees outside the fees that are disclosed in the vehicles. I mean, it's something as simple as that. Like, it was a foundational principle when we set Keyview up that the only fees that we charge, obviously, are at the fund level, being a management fee and a performance fee. To think that groups were taking underlying fees consistently at the loan level, or similarly taking loans onto their balance sheet and then selling them to investors at a different rate. Again, it's not necessarily illegal, but it's if they're doing that without disclosing that and allowing investors to make adequate assessment of those is what ASIC's highlighting. So again, for us, it's continuing to amplify all those things already in place around governance, independence, independent valuation frameworks, and things that we continually get our feedback from our investors is what are additional information they need is probably the one area that we'll, like any firm, continue to grow in awareness and development of the reports that we do.
So what do you see as the biggest forces that will drive private credit this year?
I think the number one's got to be liquidity. Ultimately, we're sitting in a market environment at the moment where there is a lot of liquidity. Ultimately, private credit's like every other industry where it's a function of supply and demand. And when you have a lot of supply, a lot of capital looking to be allocated into new loans, new deals, it ultimately leads to higher pricing, which in this instance means lower returns for investors. And so what happens from a market perspective and the discipline of some of the larger players in terms of how they allocate is going to be a key element as the year plays out. What I should say within that as well is people forget with private credit, if you have $100 under management and a 2-year duration of that portfolio, it means every year you're having to reallocate $50 of that. So if you put that in a larger term, if you're a $10 billion manager and you have a 2-year average loan duration, it means that the year coming up, you need to re-underwrite new loans for $5 billion. That's before you grow. And there's a lot of groups that have grown quite precipitously in recent years. So they need to continue to write a lot of loans to maintain their current book, let alone continue to grow as they aspire to do.
Alex, where are you finding the most compelling opportunities and how is that being reflected in your portfolio today?
Keyview specialises in what we call opportunistic or special situation deals. And so we do that through market cycles and we've done that for a very long time. What does that mean? In simple terms, we specialise in providing borrowers capital where they need it in a more expedient time frame than a standard bank or non-bank lender can get it to them. They have a complexity to their business or asset structure, or we can structure the loan in a manner that doesn't allow us to take more risk but solve something a bit more innovatively than a standard lender would do. All of those things allow us to not compete with the mainstream, not to be overwhelmed by the amount of excess capital that's in the market. So what that means is we typically achieve a higher rate of return for the loans that we're making without taking incrementally more risk. So that liquidity issue that I spoke about earlier, we think that will be a continuing thematic of this year, but ultimately that doesn't impact us in the same way it would other non-bank lenders or banks for the same reason, because we're not competing for the same loans as other main market participants are.
Alex, you mentioned Keyview's specialty is opportunistic lending. Can you give me some examples of that?
If you start with standard lending, be it bank or non-bank lenders, it's all about volume. And things then squarely sit into a box that needs to be ticked. And so you typically have individuals working there that can look at set pro forma information and see where that fits into the box. So if you're a borrower and you don't fit into a box, it's very hard to engage with those parties. So Keyview sits in between standard lenders and raising equity. And what that can be is one of three things we typically talk about. First of all, we can move more expediently. So we have funded deals within a week of having the initial request. Now, they would be very low, what we call loan to value ratios. So it might be that a counterparty is borrowing $20 million, but they have a collective $100 million of assets that we can take security over. They're typically very short-term loans, but the rates of return on that are very, very high. And that might be the rationale for the borrower to do because they've got a short-term merger and acquisition opportunity. It might be that another bank or non-bank lender has actually fallen over and stopping them settling on a transaction. There's a whole variety of those things. The second example that we talk about is complexity. Now, that doesn't mean that we're trying to solve things necessarily which are harder, but if you come along with your financial affairs or your assets and it's all a bit muddled and mixed, and that can just take time to wade through, and by time it could be months. We've found many opportunities where people haven't presented their asset base well, they haven't presented their financials well, and we've acted almost in an advisory capacity to help us understand and them understand what it actually is. But for that, we're then in a position to fund them at an attractive rate, even though we're not taking more risk there because they've got a very attractive asset base or set of financials that they, again, haven't presented well. And the third example really comes down to structuring, and what that really is where we are putting a structure together for a counterparty where we might be combining a whole variety of different assets, or they have different lenders on different assets. We're combining those into a collective asset pool, and we have sets of covenants that allow them to go forward with some business or other opportunities, amalgamating those collective through some innovating structuring techniques that, again, differentiate us and allow us to charge a higher rate, but give them potentially a better economic outcome than they would have in their status quo.
Okay, so in addition, what are the key risks investors should be most alert to right now?
With large amounts of liquidity in the system, it's like any market environment where there's a supply-demand imbalance. So if investors are exposed to private credit and they're exposed to managers that have had large increases in FUM, they really need to be ensuring that the capital's been allocated efficiently, that they're getting adequate disclosure. And that's a simple way of saying that they're comfortable with the amount of credit risk that's been taken. It's been a long time since Australia's had a recession. So you've got a new industry that's gone a long extended period without a major downturn. And so investors just need to be very comfortable that the issues that ASIC have identified don't apply to the managers they're exposed to, that they've actually already got appropriate governance, they've got appropriate resources in all the requisite areas, they've got the appropriate workout skills that sit within the business. All these things that we've been focused on since the inception of the firm are just going to become relevant, should be relevant at every point in the cycle, but are equally relevant when, as I say, things appear very, very expensive or there's, a large amount of liquidity sitting around.
All right, finally, Alex, let's look ahead over the next 3 to 5 years. What do you expect the private credit market to look like and what should investors be monitoring?
Look, it's a great asset class that's come to the fore in recent years. I think it will continue to grow and I think it will mature well. I think all the elements that ASIC have identified are really valid. There are groups, like I'd like to think of ourselves, who've set ourselves up correctly from first principles. We'll continue to reinforce all those elements as we should from a governance standpoint, but I think the industry will mature into those where they haven't fully adopted them as they should have up front. And that will be a much better outcome for investors. Unfortunately, there probably will be other instances of fund managers being found out that they haven't had the right underwriting standards, they haven't had the right governance, they haven't had the right valuation policies in place. All these things ASIC are identifying. And I think that, quite unfortunately, there will probably be more instances of capital loss. But as a whole, I'm very, very confident the industry will be in a much better place in 3 to 5 years' time than it is today.
Okay, great. Thanks, Alex, for sitting down with Livewire today.
Thanks, Emma.
If you enjoyed that interview, give it a like and don't forget to subscribe to our YouTube channel. We release new content every week.